Thanks for joining the enlightenHR Workplace Advice Group Pensions webinar. There's some important changes to auto-enrolment, and they received royal assent on the 19th of September, so this is very timely. And we wanted to make sure you're fully up to speed and can plan for those changes before they actually become law, which will happen sometime, we think, next year. Whether it will be April or whether it will be towards the end of the year, we're not quite sure yet. Just to introduce Josh and Workplace Advice Group, we've been working with Workplace Advice Group for a number of years after auto-enrolment started, just because we believe that they work in a very similar way to enlightenHR. They have a very similar ethos about providing great advice in a cost-effective way. So I'm delighted to introduce Josh Stock from Workplace Advice Group as the expert on all things auto-enrolment. Josh is going to talk about the changes, which will take about 25 to 30 minutes. There'll be time for questions at the end, so if you've got any questions, pop them in the chat box. The webinar is being recorded and we'll send you a copy plus the slides afterwards. Over to you, Josh.
Brilliant. Thanks, Alison, and hi everyone. Nice to meet you all. I will, you pretty much done it in a nutshell there, Alison. I don't know whether you need me, but I'll try and make pensions not the most exciting subject in the world, so I'll try and make it as pain-free as possible for you. But I will just, let me get it ready to click. There we go. This is what we're going to run through. So a bit of an introduction into auto-enrolment, or a bit of a reminder about auto-enrolment 10 years on. Started back in 2012, 2013, so it's been here for a decade now. The landmark expansion, so as Alison mentioned, received royal assent a month ago today, actually, which means it's now become law. It's just a case of when and not if, as it was previously. So there are some key changes that are happening which are going to impact really the cost of pensions for employers and employees, and also when people enrol into them. A change in the rules, as I say, it's been here for 10 years now, so it's the first time there's been a significant change like this. A bit of an introduction to salary sacrifice or salary exchange. Just in terms of the cost increase, this could potentially be a way, and something that we're introducing to clients at the minute, a way of alleviating the additional employer cost and cost to employees by introducing a salary sacrifice or salary exchange arrangement. And then also just we'll touch on company pension schemes in general and why it might be time to consider exploring whether it's possible to improve your pension scheme. 10 years on from when these schemes were set up initially, the market is considerably different than it was then. And not every pension provider is created equal, as we'll go through, from charging perspective, performance, all that type of stuff. So we'll investment choice, things like that. So we'll touch on that briefly as well, and then kind of a quick run through of our process and how that works. But yeah, feel free to ask any questions if you can pop them in the chat, which should be able to see at your side, and I will pick those questions up at the end and hopefully answer all of those questions that you've got. Super. So 10 years of auto-enrolment. So introduced initially in 2012, largest employers first, the smallest last, or kind of newer employers last, newer payrolls. It's been a huge success, auto-enrolment itself, as a piece of legislation. There are now 23 million workplace pension savers in the UK. Compared, if we look at the kind of participation rate, certainly in the private sector, public sector saving always, very high, very high enrolment rate, big final salary schemes, public sector schemes, effectively like the NHS, or, local authority schemes, fire service, police, that type of thing. So always quite rewarding schemes to take up, has always been quite high. But the private sector lagged. It wasn't compulsory for employers to have pensions in the UK. Various different pieces of legislation around things like stakeholder pensions being introduced, where take-up wasn't high, and it was more on an opt-in basis as an auto-enrolment basis. So they tried it the other way around, and it worked. Over doubled the private sector participation in pensions from around 42% up to 86%. These figures are up to 2021. Takes a little bit of time to filter through. We pull this through Office National Statistics, so it takes a little bit of time for the data to get pulled through. But as of 2021, near 90% private sector enrolment rate. Over £33 billion more saved in 2021 versus 2012. So it really, did what it set out to do. But there were still some categories of workers that essentially fall through the cracks currently. One of those is younger workers, so 18 to 21-year-olds or even under 18-year-olds. So the minimum enrolment criteria age-wise for automatic enrolment into a pension scheme is age 22. So anyone that is under that doesn't go in automatically and has to opt in. And again, given the choice, younger people might, I don't know, possibly rather spend it on a night out or a pair of shoes, something like that. I don't know. But yeah, younger people currently falling through the cracks. Part-time workers as well. So if there's a lower earning threshold for auto enrolment in order for contributions to be calculated on, it needs to be over 6,240 annually. So people that earn under that on one payroll currently fall through the cracks. If you have someone, for example, that works in a restaurant part-time, earns £500 gross per month, they are not eligible for any employer pension contributions under the rules. So yeah, currently another category that falls through cracks, and generally just lower paid workers, like I say, part-time and lower paid workers currently falling through the cracks. So that's why the government has looked at expanding auto enrolment. So it has solved the problem. It's got more people saving £33 billion a year, more if we're looking at 2021 going into pensions. It's done a lot to solve the problem, but there's still some people that are just falling through the cracks. So when me and Alison first talked about this, it was still a kind of a proposal. It hadn't quite got to the point where it was law, but on the 19th of September, it received royal assent. But the actual legislation is called the Pensions Extension of Automatic Enrolment No. 2 Act. Nice and catchy. But yeah, 7th of March, it was backed. The private members bill was backed by the government. We needed to go through that process of readings through the House of Commons and House of Parliament, and it did that, and it was passed, received royal assent, passed its third reading on the 19th of September, which effectively means it's now become law. So it's not a case of if, it's a case of when, and there are two key changes. And first of all, to help explain that, just to kind of refresh your memory in terms of how the pension contributions are calculated, qualifying earnings takes into consideration earnings between £6,240 annually and up to 50,270. 6,240 is that lower earnings threshold, and the 5270 is the current higher tax trigger. So it only takes into consideration earnings between the lower and the upper bandings. All earnings really fall into it. So salary, wages, commission, bonuses, overtime, even maternity pay and paternity pay. But it's only earnings between those bandings, and the current percentages since April 19, 3% employer pension contribution is the minimum, and a 5% pension contribution from the employee. Now they actually only pay for themselves. 1% of that is tax relief, so it's 3% and 5% though, they are the minimum thresholds. And one of the changes is around that lower threshold there, that 6,240. So the two key changes. One is reducing the minimum age. So they're looking to reduce that from age 22 to age 18. So the automatic enrolment of employees aged over 18 will be a requirement when this comes into effect. And the second is to apply the mandatory 8% that we were talking about just then to earnings from first pound of earnings, as opposed to over that lower earnings limit. So it will almost be as if that 6240 has gone, and it will just calculate contributions up to that 50,270. So the upper threshold is planned to remain. It will help millions of people, including lower earners and younger workers, part-time workers, enrol into the scheme. And just as a bit of calculation that we've done at our side, for an 18-year-old, the additional pension contributions would mean a difference of nearly £60,000 when they reach normal minimum pension age, and that's the age in which they will effectively normal minimum pension age currently is 55. That's when you can access pension benefits. It's set to increase to 57 by 2028. So for an 18-year-old enrolling into the scheme next year, as an example, they will be able to access it from 57. So that's assuming 8% of that 6,240 compounded over 39 years, 5% net return. But yeah, it could be a difference of over £60,000 potentially. So they're the two changes: reducing that minimum age from 22 to 18, so people will start to enrol 4 years earlier, and scrapping that lower earnings limit, so contributions will be calculated from first pound of earnings. Just gone through that. When? So the bill, first of all, has a statutory requirement to consult on implementation and timing. What they don't want to do, we're looking at quite a significant increase in cost for employers by the reduction of that threshold, and we've worked out some figures for you that I'll go through on the next few slides. And also a significant increase in cost for the employees. It's as if each individual employee has earned an extra £6,240 per year, for pension purposes. So we're looking at a significant increase. So they've got to be careful about how they introduce this, especially at a time when cost of living it has increased as much as it has over the past 12-18 months as a result of COVID and war in Russia and Ukraine, inflation where it is, mortgage rates remaining high, and still businesses having a bit of a difficult time out there. So they've got to be really careful about how they introduce this. So there is a consultation period with Parliament, and that really they'll just make sure that it's done in the right way. Their ambition to get this set up was the mid-2020s. In my eyes, the mid-2020s, 2024 through to 2026. So it might mean that we can see this enrolled as early as next year, or start to kind of be introduced as early as next year. Date is yet to be confirmed, but we'll probably find out more in the autumn statement or the spring budget. And that initial phasing of auto-enrolment that we showed on the slides before, when we were looking at 3% and 5%, April 2019, it got up to that top level. The initial phasing of auto-enrolment, anything to go by, it could also be phased in. So it might mean maybe reducing the threshold by half and then down to zero. Again, no, that's just all kind of guesswork at this stage, but we'll probably find out more towards the end of the year or early next year in terms of when. So this page here just illustrates the kind of cost increase that we're looking at on a per member basis. So for one employee solely, that additional £6,240 of pensionable pay at 3% employer pension contribution would equate to just over £187 per year in employer pension contribution. Per employee. If you're looking at a 5-employee company, it's not far off £1,000 increase per year. And obviously, as we scale up, the increase becomes more significant. For the employees, looking at about £312 per year. So it's they don't pay all of that 312 themselves, because there is an element of tax relief in there, but it works out at £20.80 per employee per month increase in cost. So increase or reduction to net pay, if you look at it that way. So there's going to be an increase for both employers and employees here. And as I say, certainly on the employer side. It's just someone else jumping in there. I'll just let him. As I say, as the employee numbers increase, you're looking at an increased cost there as well. Now, this is assuming a scheme using qualifying earnings, because if you calculate contributions on a different basis other than qualifying earnings, it's only the age the age rule change that will affect you. So there are different ways that you can calculate contributions under auto-enrolment. You can calculate it on total earnings, so all pay that goes through payroll is pensionable. That will be Set 3 certification. And you can calculate it on basic pay as well, or what's called pensionable earnings. So you can calculate it just on someone's basic pay, and that will be Set 1 or Set 2, two different levels depending on how much of the total pay is made up of actual basic pay. So there are lots of different calculations you can use. Qualifying earnings is the standard calculation. The vast majority of auto-enrolment schemes that were set up as a result of auto-enrolment are set up on qualifying earnings, because that's the standard basis. But if you do calculate on Set 1, Set 2 or Set 3, the actual increase that we're looking on screen here might not affect you, because you may already be calculating it on that basis. That's probably one important point to mention. If you want to find out how you're calculating contributions for your scheme, feel free to get in touch after today. I'll pop some contact details on at the end, where you can get in touch through Alison, and I'll be happy to help you work that out. But yeah, looking at a significant increase in cost there for both employers and employees, probably the key message. So salary exchange. So some of you may already have used salary exchange or salary sacrifices. The two terms are interchangeable. HMRC are trying to move away from sacrifice, because it sounds like you're going to slaughter a lamb. But yeah, exchange is the term that they're trying to use more frequently now. So you'll see that on the HMRC website. But just a bit of an introduction to what salary exchange is. Salary exchange is an arrangement where an employee gives up part of their future earnings in exchange for a non-cash benefit. In this case, an employer pension contribution. You might have had experience of using it with maybe childcare vouchers previously, or possibly like cycle to work schemes or electric vehicles, things like that. But in the context of what we're looking at right now, we're talking about pension contribution. So an employee can decide to give up part of their bonus as well. It's something called bonus exchange. But for this, the salary that's being exchanged, which is usually an amount equivalent to their pension contribution for the context of pensions, rather than being paid through payroll, it's deducted from the salary and paid into the pension. So they don't receive that money as income and then pay pension. It's effectively sliced off the top of their salary and paid into the pension as an additional employer pension contribution. And because of that, because they're not paid it and it's paid directly into the pension as an additional employer pension contribution, there are no employee or employer national insurance contributions on that amount that's sacrificed. The exchanged amount, as it says there, paid into as an additional employer pension contribution. And there are lots of different ways that you can set this up. So there's two national insurance savings there, one for employer, one for employee. And what happens with it is really your decision as an employer. That you can keep the costs exactly the same, so employer costs and employee costs, where both savings are reinvested into the employee's pension. That's option one. You can have it, and there's lots of different variations, but the most common method that we're going to run through is option 3. And this is the most common option because it's the easiest way to set it up from a payroll perspective. And it's also the way that the majority of payroll software manages salary sacrifice by default. And effectively what that is both parties keeping their national insurance savings. So the employer keeping their national insurance saving and the employee keeping their national insurance saving through salary sacrifice. And considering the changes that we've just talked about, this could be viewed as a way to offset the future increase in cost for both employer and employees, all or in part, in all for the employer's sense, in part or for the most part for the employees. So employer and employee national insurance contributions would decrease based on that reduced salary. So here's some examples. This assumes someone earning an average salary of 30,000 per year per employee, and each of them exchanging 5% of their salary for a pension contribution, and obviously 23, 24 thresholds that we're looking at. But for 5 scheme members, and this is if you introduce salary sacrifice as your default method, assuming 100% take up, 150,000 would be the total yearly salary before exchange, 30 times by 5. The 5% contribution on that would be £7,500. So that would be the amount of employee pension that would be sacrificed, about the earnings that would be sacrificed. At the current employer national insurance rate of 13.8%, that would be an employer annual saving of £1,035. And then the employee's total, assuming that the sacrificed amounts fall between the primary and upper earnings level, it would be a saving in total for the 5 employees of about £900 per year. I've got an individual example that we'll look at on the next slide. But you can see there, by introducing salary sacrifice as the default method for your scheme, or by achieving a 100% take-up introducing salary sacrifice, you can alleviate all of that employer cost and most of the employee cost increase as a result of the expansion of auto-enrolment. And that's assuming option 3 is selected and the money's not paid back into the pension. For an individual example here, again, looking at 30,000 per year, sacrificing 5% or £1,500. Before salary sacrifice, the gross salary would be 30. After salary sacrifice, it will be 28.5. And it's not that the pay has been reduced. All that's happened is the 1,500 has been taken off the top line of the salary and paid in as an additional employer pension contribution, as you can see on the second line there. So instead of the 3% or 900, the new employer pension contribution would be £2,400. So it's taken off the top line, paid in as an additional employer contribution. Because the 1,500 hasn't gone through payroll, the reduction in cost to the employer is £207 per year, and for the employee that's 13.8% NI, the 207, and the increase in take-home pay or reduction in NI cost for the employee, £180. So employer has saved £207 in this example, employee has saved £180. So again, going away to reduce that the impact of the change in the rules. Super. Important things to consider. Salary sacrifice it almost makes a no-brainer when you look at it on screen there. You know, just changing the method in terms of how the contributions are calculated, directing money from the taxman into company and employees' pockets. It looks like it's a no-brainer. There are some important considerations though. So certain categories of people employees can't go into salary sacrifice arrangements. One being those that earn under the personal allowance. It's not that they can't go into a salary sacrifice arrangement. It's just that it would be more advantageous for someone that earns under the personal allowance potentially to make personal pension contributions. They might benefit more that way.